Welcome to This Week in Money. I'm Jim Goddard. Today, is shorting without an uptick rule devastating Canadian stock markets? We'll find out from American Manganese CEO Larry Reaugh. Glen Kelleway from Kelleway Mortgage Architects tells us how you can save tens of thousands of dollars when renewing or applying for a mortgage.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Larry Reaugh, CEO of American Manganese. Welcome to This Week in Money, Larry.
Well, thanks, Jim. I'm glad to be here.
Today, it's going to be Uptick Rule 101 to start off the show. Then we'll get into perhaps the futures market and what's going to happen there this month and over the next few months. First off, we'll be talking uptick. What was the uptick rule in Canada and the U.S., and why was it put into place?
Okay, the uptick rule's been around since the late 30s, and it was put into place because of the volatility and the plunging of the market after the Great Depression of 29. And the uptick rule is simply this. You can't sell stock unless you own it, and if you sell stock that you don't own, you have to do it on an uptick, which means if a stock is trading at 100 or $1, then you'll be able to sell it at $1 if the next trade's $1. And that, kind of reined in the short sellers. And they also had to borrow the stock. There was no naked shorting in those days. And that rule was adopted both in the United States and Canada. And it certainly had a very positive effect on the markets. And it was there for the next 70 plus years, and now it's gone.
So if this rule worked so well, why did they take it away?
Well, the conventional thinking at the time, the first one to get rid of the uptick rule, or repeal it, which means it no longer exists, was the U.S., the SEC, and their rationale was that it made a more level playing field in the market, that the market could react to abnormalities like where stocks were on a runaway with no underlying factors, that sort of a thing, and that it was more fair to the investors. So in July of 2007, they repealed the rule. And, of course, when you repeal the rule, that means you don't have to wait for an uptick. Now you can hit the bids. Be very crass about it, it just basically means you can smack the bids all the way down. If you've got a stock at $1 and the next bid's 95 and the next one's 90 and the next one's 85, let's say there's 1 million shares on each of those bids, wham, 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 wham. You can knock them out. And you only have to borrow in certain circumstances, which I'm not familiar with what those circumstances are, but basically it's naked shorting. So they basically had their head handed to them in 2008 because of the shorting, which just poured fuel on the fire when the market was in a correction period. The shorts just took it down probably 3 or 4 times more steeply than it should have gone down. You had stocks in the U.S., and I'm talking about the U.S. because this is history. And you had stocks in the U.S. that were trading at much higher prices than they were 5 days later. And I'll give you an example of that. For example, Bear Stearns. We all remember Bear Stearns. It doesn't exist anymore. It was trading at almost $62, and it went to $2.84 in just 5 trading days. The volume was equaled 4.2 times the total shares float, so there was no stopping that stampede. Fannie Mae, who had been selling it a year earlier at $49 a share, was selling at 49 cents. Freddie Mac had the similar price decline. So Lehman Brothers is another one that was at $16.20, and it went to 15 cents on a volume 3 times their total float. That's because of the shorting. And what had happened was that the investors, the buyers, were getting wiped out. You know, somebody has to buy that stock that's being shorted. And let's put it this way. When the short comes in, you buy the stock, and then the next buyer gets knocked out below you, and the next one below you. There's no floor. So you're just going to stand there and lose everything you have unless you can leap back into the market and reduce the amount that you're losing.
So does the U.S. still have the uptick rule, and does Canada have the uptick rule?
Well, the U.S. during this period of time had the uptick, didn't have the uptick rule. Canada did. But after much pressure on the SEC, they reinstated a partial rule in early 2010. And that partial rule said that you can't short a stock down more than 10% a day, and you got to let it sit for 24 hours. So virtually you just can't keep slapping out the bids, beyond 10% down. And that seems to have stopped a lot of the volatility on the downside. And of course, since then, in 2010, at which time the Toronto Stock Exchange was 2,500 points above the Dow has gone on to highs of over 17,000. So that's a 7,000 point gain since the reinstatement of the rule. Canada, and they approved, or the regulators approved the repeal of the uptick rule in early 2011, and it went into effect in March of 2012. And since that time, the venture exchange has gone down about 65%, and the Toronto Stock Exchange went sideways. The Dow overtook it, went way past it, and then in late 2013, finally, some legs developed on the Toronto Stock Exchange, and I was hoping that we were seeing an area here where they were going to reinstate a rule or a partial rule like the U.S. did. And so we went through like that. But right now, you can basically sell stocks in the U.S. You take it in Canada, I mean, you take an illiquid market like the venture exchange. If you want to talk about an exchange, it can be really brutalized because it doesn't have the liquidity that the big boards have. 90% of the stocks have been are down, way down, 90%, 95% from their highs, and you can see the stocks out there. If you follow them, you'll see which ones are being shorted. Of course, in order to create a short, you need volume on the stock, which means you need buyers. You have to have somebody buy that short. Good news is one of the things that went through the 2011-2012 period into 2013, where buyers would come off the sidelines and start buying a stock on a positive feasibility study, a new enlarged resource, a new discovery. And that created the buying, and that attracted the predatory shorts. And of course, they sold that stock and knocked out the bids until the buyers became sellers, and then they bought the stock back. And basically, it's a transfer of wealth. It's a transfer of wealth from the investors to the short players.
And of course, the venture exchange is vital if you're going to explore for natural resources.
Well, the venture exchange is vital not only in the natural resource sector, it's also vital in some high-tech issues and other fields that where incubation takes place. They are certainly as exposed to this short rule, or the non-existence of the short rule, as the resource stocks are. So really, how do you get confidence back in the market? Every time somebody buys stock, it goes down the next day. You buy for good reasons, it goes down that same day. And pretty soon everybody pulls to the sidelines or goes broke. And there's a lot of people who have gone broke for, like the U.S. experience was that millions lost their total savings and their retirement funds. They just got caught in these downdrafts, and there was no saving them, and that wealth was transferred into the banks. It's simple as that.
So what's the solution to this?
Well, the solution historically tells us that we should reinstate the rule, because this is what the U.S. did, and they've been on a rampage up ever since. And, for example, if you want to look at the difference between the exchanges, we look at the U.S. Dow Jones, which in September, the prices started to collapse and the indexes started to collapse. The Dow went down 3% as of today. The TSX is down 7%. The NASDAQ is down 4%. The Venture's down 15%. Then everybody says, well, the commodities are all down. Well, copper's down 4%. Gold's down 4%. That certainly doesn't call for a rout in the venture exchange. So, those arguments don't hold water.
Germany banned shorting. Is that the solution?
That is the solution. That's the more drastic. The uptick rule seemed to have worked for years, but the ban of shorting, because of the computerization of trades today, the computerization of shareholdings, it's very difficult to stop naked shorting, which means stock that's not borrowed, you just sell it, drive the price down, and buy it back tomorrow, right? So, maybe that's more of a solution than we think it is, because basically this allows the investors to make money. Why do we call them investors? They invest to make money, right? They invest their money in shares or in equity financings in order to build the company to create value. The short players are not there to create value. They're to create money for themselves. In the process, they destroy companies.
So you get to be a wrecking ball with your computer.
You can be, you can, and certainly it looks to me like there's groups that gang up on stocks and coordinate their efforts. There's some stocks out there which we call, you can call them a death spiral, where there's lots of trading goes on, but the general direction is down. And that trading will create, tens of thousands of dollars in a month for smaller players. And, you can't blame them. I mean, the rules are there to where they can make money. They can't make money by and long. So if they adapt quickly enough, they become short players, and they can make money doing that at the expense of the investors. But, and the reality is that a lot of us want to build and don't want to tear down, and it's a mindset that is very difficult to overcome. So, we don't join the group on the short side of it.
So if you ban shorting, basically what you're doing is it's kind of a stop loss plan, is it?
Well, you're basically saying, let's take this company here. It's increased its resources. It's hit some higher grade. Its earnings are going up, and it's bringing value to the shareholders, and allows the company to build on the foundation of building a better company, building better resources, which makes a better company, building profitability, which makes a better company. Shorting is exact opposite of that. Shorting is making the bet that the company's going down, even though it's paying a dividend that's going, and the asset value is going up. The short players are betting that it's going to go down. But if there's no short rules, they can pretty much master the direction of that company going down. There's no stopping them. Shorting is, you got 100 million outstanding, you short 300 million. Where'd the other 200 million come from? Well, it's naked shorting. They've got an infinite supply of paper on that basis, and they can pound these companies into dust.
We'll have more with American Manganese CEO Larry Reaugh right after this on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking to American Manganese CEO Larry Reaugh. Larry, are we going to see a classic October market meltdown, just judging from what's happened in September going into October?
Just before I get into that, because it relates, first off, I'd like your readers, if they want to go on Google and Google repeal of the uptick rule by Barbara L. Minton, dated December the 5th, 2008, they'll get a story of how the devastation of the short rule, the non-existence of the short rule, can create. And the other thing I'd like to say is I do believe that, that our regulators, in their wisdom, will reinstate either the uptick rule or a rule similar to what the U.S. has in order to bring confidence back into the market and allow companies to start building. And, Jim, you have to be aware that there's tens of thousands of jobs have been lost directly in the junior space alone. And if you multiply that by 4 or 6 for the other effect out there for other people that are employed as a result of that employment, the Lower Mainland here has probably lost 100,000 jobs.
Wow. And of course we have Statistics Canada telling us that their statistics on unemployment aren't all that accurate because they don't do a big enough sample. Why don't they do a big enough sample so we can see where jobs are being lost or created and maybe have some impact on it? Right now they have an imperfect system where they go, one day they'll tell you there's 200 jobs created. Oh no, we meant to say 41,000. But their statistics aren't accurate. Does it hurt people like you who want to have accurate numbers for your planning?
Well, certainly, if they had accurate numbers, I imagine that the BC, our leaders, the Premier and members of Cabinet would be pretty concerned about the loss of jobs in Vancouver if they could see that number. And certainly people would be concerned about it. And, that might help us get the uptick rule reinstated. Certainly, these surveys, I think, are self-serving in a lot of ways to kind of pull the blinders over our eyes that things are not as bad as they really are.
I've heard that there is a ton of business office space available in Vancouver now. Last
I heard was in 2012 there was 50,000 square feet available. In 2013, there was 500,000 square feet. I don't have a recent number that I've heard.
Well, obviously, it's going to be worse.
Well, you even look at the operations like mine. I used to employ about 11 people. Now I'm down to 1. And, so there's 10 gone. You take 1,000 companies, that's 10,000 people gone. And, there's more companies than that are affected. Some are less employees and some had more. So just take an average of, say, 7 employees. That could be 10 to 20,000 jobs that have been directly affected. That's directly. Indirectly, all your services, your consulting services for engineering, geology, for assaying, for corporate, for securities law, for accountants, it affects everybody.
Now, this is a skill set. Obviously, these people are going to look for work. They'll probably go to Alberta, where they still have a big demand for people in those specialties. Will they stay in Alberta and not come back to BC, even though we're trying to pump up LNG?
Well, there's no place for the mining people to go. Because this is not just the Venture Exchange. This is not just BC. It's right across Canada. And so is the TSE. And, mining jobs lost are lost. The only way to get them back is to start being able to raise money and get programs going again. And, coupled with the stringent environmental rules and everything else that we have to adhere to, now with a market that you can't raise money in, at the moment, that's an impossibility.
I know everybody has the best interests in mind when they come up with these environmental rules, but are some of them just totally unrealistic? that you can never live in a perfect world where everything goes exactly as planned?
Well, I've taken about 3 or 4 projects in the last 10 years through the environmental process. And certainly, it's over-regulated for sure. But we try to meet everything that they want because in order to get a project through, you have to meet those desires. And you have unfortunate things happening like the tailings spill here in BC just recently that really, as far as I'm concerned, was nobody's fault. It's something that's a 1 in 1,000 event or 1 in 100,000 event, and but it's front page news, and that makes it worse on our industry as a whole. So I can't knock the the environmental requirements because they're there for a reason. But I got to say that most of the corporate responsibility for that from the companies, they try to achieve that or even make greater achievement than that.
I know one place where this problem or this issue really came to light was the Pascua Lama mine on the border of Chile and Argentina. Because of environmental concerns about the conservation of water, a project that I think was initially supposed to cost $3 billion is now ballooned to 11 or 12 billion.
Oh, yes. This is happening all over the world. The worst thing that can happen to you is you get all your permits and you go ahead and you start construction. And then all of a sudden the government says, no, we got concerns here that environmentally, we don't feel your tailings dam was designed right, or we don't feel that you really addressed the glacier situation. You name it. And then you don't have the permit to construct, and if you do keep constructing, you're really, you're playing dice at that point. So you stop everything and you try to, mitigate their concerns. In the meantime, the project stopped for 6 months or a year. Then you start it back up. You can if it's a $2 billion project, now it's a $3.5 billion or $4 billion project, right? And those costs just mount up and mount up and mount up. You can't change your mind at the last minute, but unfortunately, it's not the companies that are changing their mind. It's outside forces.
Well, Mexico unexpectedly raised its taxes on mining. Meanwhile, Canada, the federal government, has lowered its taxes to make it a friendlier business environment. Well, the Canadian government is making more money with lower taxes. Should other jurisdictions perhaps take a look at that?
Well, you can't kill the goose that laid the golden eggs. So if your taxation system is not fair, and you're not going to have anybody developing in your country. And that's what politicians fail to see. It's not just in Mexico, there's always bills trying to get through Congress in the U.S. There's always, the Australians have had experience with that. Certainly, we in BC have had experience with that. And, you gotta have a fair and rational tax system where the corporation can make money, because the corporation, if it's operating mines in your jurisdiction, is bringing in jobs and it's bringing you a big tax base, right?
Larry, is it time for management and unions to bury the hatchet and sit together and say, neither one of us can be successful without the other? Why don't we work together, try to keep costs down, be efficient? Are we seeing more of a round table? Is that the solution? Would that help?
You're seeing, yes, that would be a solution. But it seems like the militant attitude wants to prevail. And throughout the world, it doesn't matter whether it's in our backyard with various self-interest groups or whatever. And which makes it very difficult to sit down at the table and come up, with a rational solution. But that has to happen. Or otherwise, our industry is going to shut down.
Well, before the last provincial election, the NDP leader met with hundreds of BC business leaders, but I didn't see one of them endorse him because the other members of his party were doing their typical, I call it, eat the rich campaign. So I don't think, people in management were convinced that we're going to be a pro-business government if we're elected.
Well, we've had our experiences there. 1973, when they came in with the super royalties bill. Do you know that it was not until very few years ago that a lot of major companies started looking for projects in BC again? And, and now, it's tenuous. I mean, how long is this going to last? We have other forces at work here that, could prohibit projects from going ahead. Back in the 80s, it used to cost me a few $1,000s to get a drill permit. A drill, very little disturbance, right? Maybe not even any roads. Today, if I want to drill a project in the U.S. and I don't even have to build roads or anything like that, it can cost me $200,000 to get a permit, and take me 2 or 3 years.
Wow! So, with those kind of costs and a market that's not raising money but losing money, how can smaller companies stay alive?
They can't. They need a better environment to thrive in, and they need a good, orderly market to do that. And the orderly market would be to, get the uptick rule reinstated and get back to business and let these companies do what they're good at, which is raise money and find resources.
And Larry, have you had any talks with people about doing that?
I've been talking myself blue in the face for about a year and a half. I think most people feel like I'm, the guy that's peeing on the parade, because, they don't want to hear that, they don't have a chance as long as that rule's in place, right? But the fact is, you don't have a chance. We're trying to survive. Investors are getting more and more wary, and less and less of them. And so we've got to have a winner. In the old days, the market used to turn on big discoveries. Suddenly you would have a few hundred people or a few thousand people making money, and talking to their neighbors and everything else, and the speculation started. That's what it's all about. It's a gamble. And you hope that you're going to be on the next discovery of Afton in those days, or today something like Boise Bay. And if you happen to be on that, you go from rags to riches in a hurry. But nobody's going from rags to riches anymore. So, we've got to get that feeling back into the market.
Larry, is there a website people can go to find out more about American Manganese?
Well, we have our website is AmericanManganeseInc.com, and I gave you that website to go to on the uptick rule. And if you wanted to see what the Canadian one is, just go to the Canadian uptick rule, and you should be able to get into the site and see what's happening.
Larry, thanks again for talking to This Week in Money.
Well, thank you, Jim.
After the break, Glen Kelleway on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Glen Kelleway, mortgage broker from Kelleway Mortgage Architects. Welcome to This Week in Money, Glen.
Thank you, Jim.
I saw a headline recently that said, wait a second before you sign that automatic mortgage renewal from your bank. And I wondered, why should I do that? Glen, maybe you can explain why just automatically renewing your mortgage could be a very costly decision.
Yeah, I think you noticed that on the Financial Post there. Ted had posted, he's one of the writers for that, had posted an article about that. So I had a chance to look at that and have a review through that, but it pretty much matches with what exists in the marketplace. People have gone and done the work, submitted their income documents, and gone through the process of getting their first mortgage, and the lender will send them a mortgage renewal. Hey, they'll send it to them typically 3 to 4 weeks before the actual renewal date. Now, if you're really proactive, like you should be with anything else, we always plan trips well in advance. We do lots of things well in advance, but oftentimes we leave the really important stuff like mortgages to the last minute. If you wait till the last minute, you're just probably going to take the lender's offer. Here's what happens with most lenders. Most lenders will offer you something higher than their best rate. And Scotiabank recently running a promotion, and you walk in and there's their rate up there, but I know it's not their best rate. The best rate is closer to 2.99 or close to around 3%, but they're offering something that's above that. Now, if you go talk to their specialist, and this is the same for all banks, RBC and BMO and everything else, in general, they'll offer you a higher rate. at renewal. Why? Because they know statistically, and this comes by research from Moritz. Moritz is a research company, and the Canadian Association of Accredited Mortgage Professionals, CAMP, hires them to do annual reports and survey the market space. And last year in a report, 2013, they found that 56% of people actually did something or rather proactive. They actually talked about rate with their existing lender or called other lenders to find out rates and negotiated a lower rate. So that means just a little bit less than 6 out of 10 did something, but 4 out of 10 took the rates. And I've gone back through my client base here and looking at the article in matches for the article that's in the Financial Post here. Basically what they're offering clients, and I've seen it recently, is 4.79 today. Well, if you look around the market space, and this is what people should do, they should look around and see, and I can give you a bunch of steps to go through, but basically look around and you'll see that 2.99 on a 5-year fixed rate is kind of the same deal. There's a little bit less and a little bit more depending on the situation, but 4.79 to basically 3%, that's a big difference there. And that can amount to thousands of dollars. On a $500,000 mortgage, that's over $47,000 over 60 months. So that's what the bank's counting on you to do that. They know 4 out of 10 people just sign that renewal. Yep, circle, initial here, done. Because it's easy for them. Unfortunately, could you do with an extra $50,000 or $40,000 over 4 years or 5 years? I certainly think that I could. So I'm going to do a little bit of research, and that's what I tell people to do. So my Jim, that's it. They're just counting on it. Oh, one other thing. When you step into a bank or the client comes to a mortgage broker, or it's a mobile mortgage sales rep for the bank, their commissioned sales staff to sell mortgages, they have to pay for that. They pay for the person who's originating the mortgage, finding the business, the sales rep, or the mortgage broker who gets paid a fee. And then they've got to pay the underwriting staff, the people that process the paperwork to put in place. So now when it comes up to renewal, it's a piece of cake for the bank. They offer a higher interest rate to the clients than they would when they're trying to acquire them. So they get paid more and they do less work, which seems counterintuitive, doesn't it?
Is it hard to get a mortgage broker?
No, mortgage brokers are out there in, I think there's 2,000 mortgage brokers that are part of the BC Mortgage Brokers Association, the province of British Columbia. Every province or territory usually has licensing around licenses mortgage brokers. They're different than the bank reps, and the bank reps, many of them do a great job, but they only serve one product. That's the bank product. If you're an RBC mobile mortgage rep or you're a Scotia mobile mortgage rep, you only have the Scotia product. Occasionally, if something doesn't fit, they can throw it down their alternative channel and get something done. But if you come to a mortgage broker like myself or anyone else that's got some experience, and when I say experience, they're doing 50 to 100 to 200 mortgages a year under their own. That's a decent amount of experience. Then they're going to look and say, okay, I could send you to TD, I could send you to Scotia, I could send you to National Bank. There's a few that we don't deal with, like RBC and BMO, used to be on our supplier list, but they're not. I can take you to Van City, one of the credit unions. There's many suppliers I have, and they're suppliers for the mortgage money. I look and see what's the best fit for the client. What are their short-term needs? You know, is someone on mat leave or pat leave? Is what's happening with that client? How does what's happening at renewal? And sometimes clients come to me, Jim, and they've gone to their bank, and they're coming back to me, and they're saying, okay, RBC is offering me 3.29. And I said, well, that's not the best rate. They will offer you 2.99. Here's what I want you to do. I want you to go back to the bank and tell them you're working with a mortgage broker and see what they do. And lo and behold, Jim, guess what they do?
Well, I think we know what the answer is going to be.
They offer them the 2.99, which is very competitive. It's competitive. It's kind of the standard in the marketplace. And the client's now shocked because they were a good customer and they were promised that they were a good customer, and that's why they were getting this rate of 3.29 or 3.39 or whatever it is. But the bank knows that they're going to get some of those customers to come back to them, and they're going to basically match what the broker's going to do. The client now has a decision to make. Do I stay with the lender who I felt I was married to and I've got a trusting relationship, and now they've undermined that trust by offering me a higher rate and then a lower rate, like within the space of even one day, one phone call. They'll offer that, or do I go to someone else who offered me that rate right out the bat, and then we'll spend the extra 15, 20 minutes, an hour or two working through options, explaining pros and cons. And that's really what you need, is you need an advisor going forward.
We'll have more with Glen Kelleway next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking to Glen Kelleway from Kelleway Mortgage Architects in Maple Ridge. Glen, perhaps one of the best ways to find out if your mortgage broker has what it takes to do the best job for you, should you find out how much experience they have?
The challenge, Jim, you know that to be an expert in any given field, you have to put in about 10,000 hours. In my business, that means that a mortgage broker or mortgage agent, depending on which jurisdiction in Canada, you need to be doing 50 to 100 files funded per year for at least 2 to 3 years before you reach that kind of 90% expertise. A bank rep can do those because they're really cookie cutter, because they either fit or they don't. And so they can easily do 50 to 100 files a year, but they only need a year or so as a bank rep to see most of what they're going to see, because they don't do private, they don't do a bunch of other stuff that I would do as an alternative for clients that don't fit the kind of the cookie cutter A business. But that's just me. So, do your research. Save yourself some dollars.
Does it cost me any money to go to a mortgage broker? I'm sure a bank's going to say, well, our rep is already built into our costs, so you don't have to pay anything extra for that. Does it cost extra if you go to a mortgage broker?
Good question, Jim. Mortgage brokers typically get paid by the lender who they take the mortgage. So let's just say you're with RBC, and we've just switched a number of people over from RBC. I'm licensed in BC and Alberta. So client calls in, I look, I said, what have they got? Okay, well, I tell you what, this is what I can do. Go back and ask your bank and see if they're going to match the rate. And then if they want to match the rate, ask them these following questions, because you really want good advice from them. And test their knowledge and see. And simple questions like, what are interest rates based on? What will happen if I take a fixed rate and the rates go up? It's payment shock. But the person usually will tell you, well, don't worry, you've got 5 years, you're protected. What sort of strategy? And we work through a number of questions with the clients, and then we become their advisor going forward. When I take someone from RBC and switch them at renewal, there's a couple of minor costs I cover off. Usually there's a discharge fee of about $300 depending on the province. And that's it. I switch them to a new lender, and they take the existing underlying mortgage, and the new lender, maybe it's TD, maybe it's Merrick's, which is not accessible. It's not one that's available to the general public. I switch them to one of my other lenders. They pay all the legal costs. So switching your mortgage at maturity, which we were talking about as switching mortgages, doesn't cost the client anything. They do have to do a little work, provide me with payroll statements and job letters, but they're going to get more information and more useful information as we go forward. And most times, they're going to get the same or better rate than they get at the bank. Certainly, I'm seeing lots of clients come in, and the bank will come back and match. And my costs, I'm not charging them anything for the normal mortgages. If I have to go to private money or something or other, yeah, there's a fee involved, but that's only about 20% of the time I'm doing that.
So for the typical person looking to renew their mortgage, I think, you're really right when you say you trust your bank to do the best for you that they can. But we have to rearrange our heads. Now that banks are in financial tight times, they're finding new ways to make money. I know my particular bank, the Reaugh, has increased fees by 100% in some cases over the last 2 years.
You know what? I don't want to pick on any big blue bank or red bank or anything else, but I get anecdotal reports from clients. I'm not looking at the paperwork. That's what I mean by anecdotal, where they've taken their personal unsecured, there's no property involved, unsecured lines of credit from 4.5% or 5%, prime is 3, prime plus 2 or 3, to 9%. Just like that, boom, snap your fingers. And the clients can't do anything. They're already carrying $10,000. They have been for the last few months or a year or two. So they're going to be stuck doubling their interest rate on some of these lines of credit, and it's just done arbitrarily. So the banks can do that. Remember, they're out to make profits for the shareholders. So if they're going to charge you a little bit more on your personal line of credit, or they're going to charge you an extra 0.5 point or 1 or 2%, and that's what the numbers are that suggest that there's a segment of the population that doesn't shop around, they don't do research, they pay about 2% more than their friend, their neighbor, who goes and does some research. So it pays for you to do research and go to the market, look at the rate sites, talk to your existing lender. I'm giving you points here. So go to the market, educate yourself. You can't be a professional without putting thousands of hours in. but at least get an idea as to what is out there. And then once you've gone and done the research, call the non-broker banks. Call BMO, call Royal Bank, call HSBC, talk to them, find out. They can't give you an exact number because they haven't looked at your payroll statement or looked at your property or looked at your credit, but they can give you an idea as to what they could offer, and then bring that information back to a mortgage broker. It's not going to cost you anything. Tell the mortgage broker what you've got. There's no harm, no foul. And if the mortgage broker is got integrity, which 90% of them do, and certainly the ones that are accredited mortgage professionals, such as myself, have passed a certain level of education and ethics, and we're being scrutinized on an annual basis. If you're going to an AMP, designated mortgage professional, then you know what? They're going to give you options. RBC does this, that's good, this is not good. TD does this, collateral mortgage, not good. And they're going to give you all of those things and pro-con, and interest rate is only one piece of a puzzle. In fact, it's probably, based on what a friend of mine in the industry does, it's one of 67 different points that you need to look at. So interest is important, but it's not the end-all, be-all.
And of course, too, there's the insurance that goes on that mortgage, and I'm sure there's better rates for insurance as well.
You know what? That's a very good point. Some lenders make just as much in terms of profit on they call it life insurance. They call it mortgage insurance. It gets all confused. There's really three types of insurance, four types actually. The CMHC, that's if you have over 80% loan to value on your purchase. That's a required thing. It just goes on the top. There's your fire insurance that protects your property so it burns down or covers your apartment, all of the cabinets and everything in there in case there's damage. And then there's two types of insurance that would go on there. One is it's personal insurance. So if you die, the mortgage gets paid. They call that mortgage insurance, but it's really not. It's a creditor protection insurance. So that creditor protection insurance that it was offered to me when I took my car loan recently, and the credit union wouldn't remove it from the cost. And I offered to use my own life insurance, which I've got more than enough of. Here, take off $30,000 of that, and if I die, you guys get that, and it pays off the car loan. No. So they build that in. That insurance that they offer you on your mortgage, they call it mortgage insurance, but it's creditor protection insurance. They make as much on that as they do in profit on the mortgage, and sometimes more. And quite often it's higher priced than what you would get from an independent life insurance agent. So that's a whole other subject, but there's various profit centers they make in putting that mortgage in place.
Glen, if people wanted to find out more about yourself or your company, is there a website they can go to?
Certainly, they can go to my website. A matter of fact, if you take my last name, Kelleway, Kelleway, and you put that into Google, and you add the word mortgage to it, I'm the only mortgage broker in the entire world with my last name. So you can find me there, or you can find me at my website at www.mtg, that's Mike Tango Golf, the abbreviation for mortgage, mtgitright.com, mortgageitright.com. And if you use that, you'll probably find and you do halfway spelling my last name, Google tends to correct everyone, so.
Thanks a lot for chatting with us, and I hope somebody out there saves a penny or two. If pennies still exist anymore.
No, but thousands, Jim. They will save thousands, guaranteed.
Thanks to our guests, Larry Reaugh and Glen Kelleway. And thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.